lowered.
Yes.
We've decided that it's not too dangerous to catch the falling knife. What assets should we consider in the equity portfolio? What are going to be the good buys? How do we decide what to buy after the downfall?
Rob, can you just
repeat
the question for the people at the back?
So when the market stabilized and we feel that it's stopped going down, what would we look to buy? And I think in line with what John was saying just before, for me, quality assets. I think you want to be looking at quality companies, and if you can get them at good valuations, that's what we would focus on. Especially, and I think what you're coming into is a more uncertain future. As John pointed out, I mean, at the beginning of the year, we were worried about a melt up in the market and a bubble forming. And in a lot of ways, this correction is a good thing. It gives the market a bit of a breather. But further out, a little bit more concerns about what's going to happen in the global economy. And you want to be able to ride through those downturns. And so I want to make sure I have the quality assets in stocks, credit, real estate, in everything that would help me go through that.
I think there's a connected issue related to that, and that lots of studies indicate asset allocation, and they're talking traditional asset allocation, which is still typically limited to public markets. In our approach, we take a broader approach, but it's a very diversified approach, so that right now we might have 35% of our clients' assets in public markets. So we're permanently in, quote, that defensive mode against that market melting down. And yet it hasn't actually hurt us over the long run. So if you take a look at one of the slides I showed, the stock market can be a really great place to invest money. But if I take a look at the U.S. stock market, which is one of the best in the world, for 20 years, the return is 6% a year. That's actually not much better, if better at all, than you would have got by buying U.S. bonds over the same 20 years. So I think that the asset allocation is the decision you first want to get, and then when you get it, that you're comfortable with it, you basically stay with it. So what should have happened is in the last, let's say, 2 or 3 weeks, if we were 35% in equities, we're now at some number below 35%. And that would otherwise force us to rebalance and buy equities, arguably, even if we didn't want to get back to 35%. So what that's forcing us to do, in a way, but by the model, by the discipline, is we're buying something at a lower price. And the structure is what creates the requirement to buy that asset at that lower price. So combined with sort of the qualitative approach that Rob's taking about which companies you would choose to then buy, you combine these two things and you have a model that is going to create much, much lower volatility in a portfolio than just hoping that this is a good time to buy.
I'll throw one other idea, and it's sort of contrary to what I was saying before about alternative energy and the move towards a sustainable energy. And it's a bit of a contrarian point, but right now, I didn't look at it today, but I don't think it changed a lot. You could buy Exxon and get almost a 7% dividend yield. So if you believe oil is the new tobacco, and I would point out that if you had bought Philip Morris years ago, or Altria, it would have been one of the best investments in the US market for a long period of time. Only when the vaping sort of came in that turned out to be not as good an investment. But for a long time, it was very profitable. If you believe that oil is, and the consumption of the oil is not going to go away in a growing global economy, a company like Exxon, which is, I don't think they've ever cut their dividend, you can earn 7% dividend yield, that's very attractive. And that's sort of the defensive nature I'm talking about.